You know, building real, lasting wealth doesn't just happen overnight. It takes a plan. But what if you had a blueprint for the next 10 years? Well, today, we're going to break down the key pillars for long-term financial success. So if you've got a big goal you're saving for, or you just want to see your money grow, you are in exactly the right place.
Okay, before we dive into the nuts and bolts, I want you to ask yourself one simple question. What is your 10-year financial goal? Seriously, take a second. Is it a down payment on a house? Maybe it's financial independence. Whatever it is, just lock that idea in your mind. That goal, that's your North Star for everything we're about to cover.
All right, let's think of this as our blueprint. We're not here to just list off a bunch of hot stocks and call it a day. No, we are going to build a solid, long-term plan, right from the ground up, starting with the most important part of any structure, the foundation.
Every great building needs a rock-solid base, right? Well, in the world of finance, that means having core assets that are designed for steady, reliable growth over the long haul. So let's talk about the bedrock of your portfolio. Our foundation is going to start with a giant, the S&P 500. Now, you've probably heard the name a million times, but what actually is it? Just think of it like this. You're buying a tiny, tiny slice of 500 of the largest, most successful companies in the US. When you invest in the S&P 500, you're basically betting on the long-term growth of the entire American economy. And this, right here, is why it's so foundational. I mean, look at this slide. The difference in historical returns is just staggering. We're talking about an average of 7 to 10% per year from the S&P 500, and that's even after inflation. A savings account? You'd be lucky to get a fraction of 1%. This isn't just numbers on a chart, people. This is the power of compounding growth, of letting your money actually work for you.
So what's the magic trick behind the S&P 500? It's pretty simple. Diversification on autopilot. You're instantly invested across every major industry. Tech, healthcare, finance, you name it. And that means you don't have to spend your nights stressing about whether you pick the right individual stock. You're just riding the overall wave of the economy.
Okay, so you're probably thinking, I'm sold on the S&P 500. How do I actually buy it? And that is a great question. This is where index funds and ETFs come into play. These are basically the tools that let you buy that entire basket of 500 stocks in one single, super simple transaction. They're specifically designed to be low cost and give you that broad market exposure we're talking about. Just think of them as two flavors of the same delicious ice cream. The main difference is just how they're traded. ETFs, or exchange-traded funds, can be bought and sold all day long, just like an individual stock. Index funds, on the other hand, are a type of mutual fund, and they only get priced once at the end of the trading day. Honestly, for a long-term investor, either one is a fantastic choice to get that low-cost, diversified investment.
Now for the second part of our foundation, dividend stocks. Imagine this. A company you own a piece of is so profitable, they decide to share some of that profit directly with you. In cash. That's a dividend. It's literally a reward for being a shareholder.
And this is where things get really powerful. With dividend stocks, you can win in two ways. First, the stock price itself can go up over time. And second, you get those regular cash payments. But here's the pro tip. If you reinvest those dividends, you buy more shares, which then pay you more dividends, and you create this amazing compounding snowball of wealth. Okay, our foundation is set. It's solid. Now it's time to add a little bit of rocket fuel. This section is all about looking ahead and investing in the sectors that have the potential for some really explosive growth over the next decade.
You really can't have a conversation about future growth without talking about technology. We're living through a revolution right now, driven by things like artificial intelligence, the big shift to cloud computing, and of course, the critical need for cybersecurity. The companies leading the charge in these areas aren't just changing the world, they're creating entirely new markets for investors to get into.
And looking to the future also means looking at our planet. The global move towards sustainability is honestly one of the biggest economic shifts of our lifetime. But this isn't just about feeling good, it's about a massive economic opportunity. As the demand for solar, wind, and electric vehicles continues to explode, the companies that are building that future are just set for incredible growth.
Now, while the US economy is an absolute powerhouse, it's not the only game in town. Some of the fastest growing economies on the entire planet are in places like Asia, Africa, and Latin America. By investing internationally, you're not just spreading out your risk, you're giving yourself a front row seat to participate in that explosive global growth.
Growth is exciting, for sure, but a really smart portfolio also knows how to play defense. So this next set of pillars is all about adding balance and, more importantly, protecting your wealth when things get a little choppy in the economy.
Now let's talk about something you can actually reach out and touch: real estate. For literally centuries, owning property has been one of the most reliable ways to build wealth. And why is that? Because it's a real, tangible asset that can pay you in two ways: through rental income and by appreciating in value over time.
So you've got two main options here. The traditional way is direct ownership. Buying a property and collecting rent. It's a fantastic way to generate passive income. But if the idea of being a landlord sounds like a total nightmare, there's a much simpler way. REITs. That stands for Real Estate Investment Trusts. They trade on the stock market and let you invest in a whole portfolio of properties, from apartment buildings to shopping malls, with just a few clicks.
Next up, we have precious metals, like gold and silver. These are your traditional safe haven assets. When the economy gets rocky or inflation starts to spike, investors often flock to gold as a stable store of value. It's just a classic hedge against uncertainty. So, from the oldest form of money, we now jump to the newest: cryptocurrencies. Look, there's no denying the revolutionary potential of blockchain technology. But let's be crystal clear about this. With that potential comes extreme volatility and some serious risk. This is truly the Wild West of the investment world.
This table really pulls it all together. Just look at the trade-offs. Real estate can give you that steady income, but it's not something you can sell in 5 minutes. Gold is stable, but it doesn't pay you anything just to own it. And crypto, well, it's completely off the charts when it comes to volatility. There's no single best option here. The real key is understanding how these different assets can balance each other out in a portfolio.
And that brings us to the absolute golden rule of investing in anything highly speculative, especially crypto. And I'm going to say this once, nice and slow, because it's that important. Only invest what you can afford to lose. That is not a suggestion, it's a non-negotiable rule.
Okay, we've covered stocks, we've covered real estate, we've even covered crypto, but we have saved the most important, the most valuable, and the absolute highest returning investment for last.
And what is that ultimate investment? It's you. It's your knowledge, your skills, your health, your network of people. The returns you get from investing in yourself, learning a new skill, getting a certification, building relationships will outperform any stock, any bond, or any piece of real estate in the long run. In an economy that's constantly changing, your own adaptability is the most valuable asset you will ever own, period.
So, there you have it, the blueprint for building wealth over the next decade. From that stable foundation to high-growth sectors and those defensive assets. The most important thing now is not to get overwhelmed, but just to get started. Stay patient, think long-term, and remember that goal you set for yourself at the very beginning. So, I'll leave you with one final question. Looking at this whole blueprint, which piece are you going to put in place first?